The first question I like to ask everybody is, what is private equity?
Private equity is essentially matching founders who run business or existing businesses with capital. If you think about it, private equity is separated in, generally speaking, in a leveraged transaction. So it's going to be a sponsor or a fund or even a search fund that has a pool of capital that they've raised from partners, from investors that they're looking to invest and make a return on. And then you have a business that's needing the capital to actually grow and survive and thrive. And so it's essentially matching these people up together. So finding investors to find good managers, and then those managers finding businesses, and then partnering with people like us who lend money as part of a transaction to help grow the business and sell it at a larger multiple and a higher EBITDA than when they first purchased the company.
And what's the difference between that and like venture capital?
So venture capital, it's a good question. Venture capital, really the differentiation is cash flow. So, and we see this a lot with software companies today. Venture capital tends to be companies that they have an idea, they have a concept, they're spending R&D, right? They've got people, but they don't have revenue, or they have revenue, but they don't have profitability. So venture capital requires a number of fundings, seed fundings, in order to bring that company to a multiple in time. Whereas what we do, and sort of the PE side, which is not venture, is essentially these are established companies that have positive cash flow, that can pay interest, and so that you're helping them grow. And so you'd think of venture capital as at the very start of a company, and the PE kind of traditional lending that we do is more in the probably in the middle of their life cycle, where they're still on the upward trajectory, but it's already sort of they're past the growth stage and into sort of the mature stage of the life cycle.
So speaking of what you do, what would be a good elevator pitch for Capital Southwest?
So our pitch was, look, for first of all, it's in the lower middle market, and so this is 5 million to $25 million EBITDA companies. So starting right there, that's a segment or a niche of the market where banks don't typically want to play. You're not going to see Wells Fargo or Goldman Sachs or any of the large banks, or even regional banks wanting to play in that level. Um, in all of the M&A transactions in the market, 90% of them live in the lower middle market, because Main Street America is the engine that drives this country. So there's plenty of supply of deals, and then there's limited suppliers of capital to the space, and that's mainly because people view small companies with a small company bias. These are immature management teams, and if they lose one customer, they go out of business, and none of that's really true. The deals that we're looking at in the lower middle market, these are companies that have been in business 10, 20 years. They have positive cash flow, but more importantly than that is in the smaller markets, because there is inherent risk with a small company. I can't sit here and say a $500 million company is less safe than a 5 million. That's just not true. But when you do a risk analysis, you put the right capital structure. Because if you look at what we do, we lever at 2.5 to 3.5 times, and other lenders in the lower middle market as well.